Welcome to this Killick Explains Finance video. Now, this week, let's take a look at what makes for a strong firm in a downturn. We are looking, according to a lot of analysts, at something that might be recessionary. Some are using the D word, depression. Anyway, whatever we're looking at, a V shape, a U shape, let's say, we will come out of it eventually, but in the meantime, there will be casualties. So, key question for investors. People thinking, well, maybe now's a good time to buy firms that I like, a little bit cheaper than I could, say, a few months ago. What's going to make a strong firm? Because you want to buy something that potentially is about to go bust. Background, therefore, is what? So, quite a few commentators are saying we're in for a bumpy ride in the short term, and it doesn't take a rocket scientist to realise that could well be the case, triggered by coronavirus, if not necessarily completely caused by coronavirus, let's say. And the longer that virus crisis persists, and I don't have a crystal ball, the greater the chances these pessimists are going to be right for at least a while. So what should investors look for in a share? What's going to make a robust, if you like, not I'm going to say virus-proof, because the virus will probably peter out in the summer, if Boris is to believe, but what's going to make a robust, long-term, solid bet? Or what are the companies, conversely, which potentially are a little bit less of a good bet right now? So, what does an ideal company look like? Not going to give you names, it's not my job. I'm going to give you a blueprint, if you like. So, first of all, it'll be something, so 3 criteria, that sells something which is non-discretionary, posh way of saying people need it in good times as well as bad, and is probably non-travel related. One sector that is unquestionably getting hammered, as I make this video, is the travel sector, whether you're talking about airlines or almost anything else. So we can safely say it's probably not going to be directly or indirectly travel related. It's got low operational and financial gearing. Now I'm using some terribly grand language here. I'll try and explain what I mean by both of those terms in a moment. And it generates positive cash flow. Cash is king. 3 tests. So let's take a look at each in a little bit more detail. The importance of product is what I've called test number 1, if you like. So, look for firms that sell must-haves rather than nice-to-haves. Now, must-haves are quite an interesting space because in the old days, people used to say, well, it's just things like toiletries, utilities, and so on, and that's undoubtedly true. Loo rolls selling out and all that good stuff. But other things are too. A lot of people won't give up their mobile devices until absolutely the last minute. Those have almost become the must-haves of modern day life, if you like. So there are firms out there which offer must-have items, and other firms, travel, leisure, spring to mind, that don't. And basically, this problem is not going to go away immediately, so I suspect those sectors are likely to struggle for a while yet. And a decent moat is also valuable. So if you're offering a must-have, it's probably something which is relatively hard for your competitors to copy. It's something that customers can't easily switch to a cheaper version of quickly. All right, all those things contribute to what Warren Buffett called, a decent economic moat. So that helps when you're looking for stocks that are likely to weather a downturn, offering something people need, come what may, and able to protect their market share of whatever that product happens to be. Now, second point, gearing, and I used 2 grand terms earlier on, isn't good. Okay, you might think when the market's expanding, when debt is cheap, companies should borrow to expand, and there is some logic in that argument, but when markets are under pressure, even with low interest rates, be careful. So, financial gearing is high debt relative to equity funding. Not a massive problem while interest rates are at record lows, and they could stay there for some time, but it does reduce a company's ability to take advantage of opportunities that arise in this kind of market. Believe it or not, there are opportunities for some firms out there, and it increases their overall financial inflexibility because they've got to make sure they're servicing interest and debt repayments ahead of anything else. Operational gearing is also bad news when revenues fall. Now, most people, if you've got a mortgage, for example, understand the concept of financial gearing. Operational gearing, on the other hand, is a term people understand less well, and it's crucial, absolutely crucial. So here it is. Operational gearing is this. In a nutshell, it is your business model has high fixed costs relative to variable costs. In other words, you've got big costs, property, staff, which are largely fixed. If you think about it, you can't just cancel leases overnight or sell a building. You can't just immediately reduce your workforce to 10% of what it was without incurring potentially massive costs in a lot of cases, although businesses have tried with modern working practices to get around that to a degree. But let's say, to make the point, sales are currently 100. Your direct costs of making those sales, so if you're a company that makes things and sells them, your raw material costs and so on are quite low, just 10. Your indirect costs, staff on permanent contracts, property and so on, are 80. So your profit is 10. Very simple model. 100 minus 10 minus 80 is 10. Now, this is my point. Your sales dip, because we're in a downturn, by 10%. Doesn't sound like a lot, but look what happens, because this is high operational gearing. Your indirect costs are a massive proportion of your total costs. So sales dip by 10%. That's going to take a little bit off your direct costs, just one. It's going to take nothing off your indirect costs. I'm assuming your fixed costs are fixed. It's a clue in the name. Okay, so overall, afterwards, your sales are 90. Maths isn't too difficult here, it's the concept. Your direct costs drop by 1 to 9. Your indirect costs stay at 80. Your profit has dropped to 1. 90 minus 9 minus 80 is 1. So a 10% drop in sales has resulted in a 10% drop in direct costs. It hasn't brought down your fixed costs at all, so your profits are now 90% lower than they were. 10% drop in revenue, 90% drop in profits. That is high operational gearing. Now, when times are good, it works in your favour, but times are not very good at the moment, so watch out for it. And if you're thinking, what kind of businesses have a cost base like that? Isn't that a bit extreme? Not really. Airlines have a cost base not dissimilar to that. Banks have a cost base not dissimilar to that. And that's why you may see some quite drastic action being taken if this difficult period continues for any protracted length of time. So there it is. High operational gearing. High fixed cost to total cost. Not a good look in the current climate. And cash. Cash matters. So the old cliche. Sales are vanity, profit is vanity, and cash is king. But it really is king right now. And companies in some quite unusual sectors, if you like, have decent cash mountains. If you've got a cash mountain, this is a huge market of opportunity. It gives companies the ability to buy other companies cheaper than they were even 2 months ago, if you like. It gives them the opportunity to expand easily, quickly and cheaply. They can use their own organic cash flows. They don't have to rely on debt and so on. So cash is king, and there are some sectors you might not think of that have got lots of it. So the tech stocks, for example, the big tech giants, a lot of them have built up cash mountains. So whilst during the dot-com crazy days back then, if you remember that, the dot-com boom, a lot of companies with very low cash flows were king of the pile until the market crashed, and they couldn't survive a crash. Some of the big technology companies are very cash generative. So don't rely on the old cliches, to make assumptions about which companies have cash and which don't. But it is important. Working capital management being the key. So the key to having good cash flow is getting your working capital under control. What do I mean by that? Lots of jargon coming in here. Final example. Let's say, here's your sales line, okay? Here's your costs line, and here's your profit cash flow line, respectively black and pink. So, you make sales of 100, all for cash. If your costs are 80, all for cash, your profit will be 20, 100 in, 80 out, and your cash flow will be 20. So you might be thinking, well, what was the point of that example? Well, let's change the facts a little bit. Let's say only 10% of your sales are for cash. Now, watch what happens to the cash flow. Now, you may have sold 100, great, you're selling stuff, you're only collecting cash of 10, your costs are all cash. Now, all of a sudden, your profit may still be 20, because that's done on the basis of what you've sold and the costs you've incurred. That's how profit and loss accounts work. But your cash flow is now massively negative. But what if 10% of your costs were also cash? How would your cash flow look? Well, you'd be getting 10 in from sales, spending 8 on paying suppliers, leaving you with a better overall cash flow position, but less than your profitability. So if you're losing the numbers, what's the point I'm trying to make here? Cash matters. The extent to which businesses can collect cash from customers, the extent to which they have to pay suppliers immediately matters. Small businesses tend to be under more pressure cash flow wise than large ones, but businesses of any size can get themselves into trouble on a cash flow basis. Don't assume big is beautiful when it comes to cash flow management. So there we have it. Three things to think about there in terms of what makes a strong company, or conversely, what makes a company that could be struggling soon. Use your email address with queries, and to watch related videos, it's killick.com/learn.